Hello everyone, my name is Zhirui Yu and I am an undergraduate student from the University of Denver and my major is finance and have a minor in marketing. The paper I will be presenting today is titled Analysis of the Influence of Enterprise Mergers and Acquisitions on the Stock Market. And for now, I'll share my screen. The reason for researching this topic is the news of the Elon Musk acquisition of Twitter, which I followed in the first half of the 2022. As an emerging market involved, M&A can be seen in almost every event that affects the direction of the market, especially in stock market volatility, where the impact of M&A is sometimes a factor that cannot be ignored. In many different situations, M&A can have a different impact on overall stock market volatility. So I will use literature rating and analysis to improve in-depth measurement of corporate M&A activity by analytically showing the intrinsic relationship between stock market turbulence and corporate M&A transactions. The keywords covered in my article are merge and acquisition, stock price, financial traps, M&A risks, and complementary. This will help us better understand the link between corporate M&A and the stock market volatility. So, energy and international recent issues resulting from the wars in Russia and Ukraine have taken the lead as a source of leading stock market volatility, while the US has been implicated in the economic system's turmoil with multiple interest rates hikes in response to uncontrollable inflation. In April 2022, Twitter accepted a $44 billion buyout deal from Elon Musk, and the deal caused Twitter's stock price to spike within a week, but it slumped about 13% in the months after reaching a yearly high in late April. Meanwhile, the value of Musk's Tesla's stock also fell. So as a result, we are able to see a lot of volatility in the stock market as a result, with companies like Tesla and Twitter experiencing particularly high volatility in their share prices. So what do mergers and acquisitions of companies bring in the course of a market economy? Through the study, we will have a clear grasp of corporate mergers and acquisitions themselves and the impact they bring to the stock market, thus gaining a better understanding of the link between corporate M&A transactions and stock market volatility, as well as the risks and finding better returns. So, mergers and acquisitions are an important strategy of companies seeking their own growth and industrial leadership. Moreover, it is a fundamental option for companies to take the initiative in the market, especially in the stock market. So, in the first half of 2022, oil and energy issues received a lot of attention. As the price of oil rose, oil stock prices fluctuated in waves. Here we have to mention a very famous person, the oil tycoon Rockefeller. Mr. Rockefeller, uh, he executed a really successful corporate uh, acquisition tower from an oil refinery with a registered capital of $1 million at its inception to a trust controlling 90% of the U.S. oil supply. Rockefeller provided a perfect preview of industrial consolidation through corporate mergers for posterity. It is safe to say that his oil tycoon and the formation of his rising stock price would not have been possible without several actresses. His this path originated with the goal of controlling the oil refining industry, seeing the right market timing to take down numerous target companies, and then by cleverly setting traps, he acquired crude oil plants in oil producing regions, a move that fundamentally solved the source supply problem. So uh, on this basis, Rockefeller searched for and used his talent to carry out the merger in the refining industry, the oil producing regions of Pennsylvania, um, which he further acquired oil transaction companies. This clear corporate growth plan led many talented people to join the wave of M&A. So thus we can see that merger acquisitions can help companies grow rapidly and contribute significantly to the expansion of their production lines and the improvement of their industrial process. So this is the figure of the Rockefeller's uh, oil companies stock price. We can see that it shows the change in the stock price of uh, the mobile oil company over the last century. So from which we can see that its stock price has been steadily increasing since the beginning of corporate mergers and acquisitions. In the process of M&A, a good case is that the company has a clear corporate development plan and goals based on which the supply and quality of products and ensured and risks are avoided while ensuring stable corporate development. The impact of such M&A policy on the stock market is bound to be positive. So for investors, an M&A transaction with a company that has stable product output and a clear development plan is a guaranteed investment. This will also lead to attract the attention of more investors, and the stock price will naturally rise slowly. So during the sixth wave of mergers and acquisitions following the 2001 recession, large amount of dollars poured into the market, and the Federal Reserve kept interest rate low to stimulate the economy. Low interest rate also contribute to the growth of private equity funds as leverage buyouts became cheaper, which also contribute to the stock market boom. This will lead to a large amount of available capital and an extremely favorable environment. In such an environment, M&A deals increase exponentially, but also create distortions. Due to massive speculation and a lack of perception of risk, many M&A deals end up ending up by overvalue, resulting in significant resources being directed to routine assets. The result was the 2007 subprime mortgage crisis that plunged the world into recession. So the negative examples, there are several. So in May 2007, CIC spent about $3 billion to purchase nearly 10% of BlackRock's stock at like a near like 29 per share, but reached a loss of $2.5 billion by October 2008. In late 2007, CIC purchased $5.6 billion face value of Morgan Stanley's mandatory convertible bonds, representing about 10% of Morgan Stanley's equity at the time. So Morgan Stanley's share price fell sharply, and the trading book flowed a loss about $3 billion. This caused the share price of CIC to fall again and again at that time, and also drove the share price of acquired company to produce huge up and downs. Also, in November 2008, Ping An Insurance Company of China announced that it had become a single shareholder in Fortis Group, having purchased 95.01 million shares, or approximately 4.18% of its total share capital, for a price of approximately like 1.81 euro a billion. So, however, this investment eventually led to serious losses for Ping An due to its lack of experience in forecasting Fortis Group's net assets. Fortis collapsed shortly after the acquisition, leaving Ping An Insurance Company of China with less than 30% of its investment, and its share price plummeted. And here are the stock price trend of CIC and Morgan Stanley since 2007. So since the stock acquisition by CIC, its own stock market sentiment has not improved much, declining all the way through the second half of 2007. Morgan Stanley's stock price also fell severely, like as a result of the M&A deal and the downturn in the overall market economy. So the reason for this negative situation is that companies do not do a good job for measuring and analyzing the value of their own situation and position when conducting M&A transactions. First, companies need to pay attention to the future direction of the market economy. And when measuring M&A deals, companies sometimes have unclear strategies and do not find external benchmarks, which also prevents them from seeing opportunity and threats. Another reason why M&A brings down stock price is that companies do not consider the risks or are too complex in their financial analysis. This can be found in the case of Ping An Insurance. Some companies lack the necessary risk awareness and do not perform a risk analysis when making decisions. The analysis result in no risk adjustment, which also leads companies to make decisions with seeing the future development risk of the company. This also leads to companies not seeing the advice ahead of them during M&A transactions until the risk becomes a loss and the company's stock price plummets to an unrecoverable situation. So here is the conclusion of the paper. So whether a company's share price goes up or down after a merger or acquisition is actually dependent on the specific circumstances. And the stronger the M&A company is, and the better the industry it belongs to, the more likely the M&A will lead to a rise in share price and vice versa. If the company being acquired is met with poor performance, there is negative news for the company making the offer. The company's performance will be dragged down and the stock price may fall as a result. However, if the company has a good outlook that will help the company make the offer, that is good news, and the company's share price may rise. In an ever-changing market economy, there are still many variables, M&A transactions, and the impact of corporate mergers and acquisitions on stock market volatility is not limited to this. So that's almost the content of my paper. And here is the references. And thank you for listening.